Hi there, and welcome to today's special episode of The Sense of Things. I'm your host, Jeff Kikel. Now, this episode is part of our Markets 101 series of videos that helps teach you about the markets, finance, and the economy. And we're going to have a great topic for you today, the Conference Board's leading economic indicators. Now, don't worry, we're going to make it super easy to understand with very little jargon. Let's dive right in. What exactly is the Conference Board's Index of Leading Economic Indicators, or LEI for short? In simple terms, it's a tool that helps us predict the direction of the economy. It's made up of 10 different factors that, when combined, can give us a pretty good idea of what to expect from the economy in the near future. Think of it like a crystal ball that can tell us if the economy will expand, slow down, or stay steady. Now, let's take a closer look at these 10 factors and see how they help us make these predictions. So factor number one is average weekly hours worked in manufacturing. This one measure covers the number of hours people in the manufacturing sector work each week. If the hours are going up, it could mean that businesses are producing more, which is good news for the economy. And the opposite is true as well. Factor two, average weekly jobless claims. This factor tells us how many people are filing for unemployment benefits. If this number is decreasing, it means fewer people are losing their jobs, which is a sign of a healthy economy. Once again, opposite is true. Now, factor three, manufacturers' new orders for consumer goods and materials. This one looks at the number of new orders manufacturers are receiving for things like cars, appliances, and other goods. When this number rising, it's a positive sign for the economy. Factor four is new building permits for residential construction. This is about the number of permits being issued for new homes. More permits means more homes are being built, which is great for the construction industry and the economy in general. Now, the other part about that too is there's some spill-off effect of new construction. Think of the Home Depots of the world and all those other ancillary groups that are out there. Now, factor number five is the S&P 500 stock index. This one's a bit different. It looks at the performance of 500 large companies listed on the stock market. If the stock market's doing well, it's a sign that businesses are thriving, which is good for the economy. Now, factor number six, leading credit index. This factor measures the lending conditions in the economy. When it's easier for businesses and people to borrow money, they can invest in new projects and grow, which helps the economy. Factor number seven, interest rate spread. This is the difference between the short-term and the long-term interest rates. A larger spread could indicate that investors are confident about the future, which is a positive sign for the economy. Factor number eight, manufacturers' new orders for non-defense capital goods, including or excluding aircraft. This looks at orders for things like machinery and equipment that businesses need to produce goods. Higher numbers here suggest that companies are investing in the future, which is great for the economy. Factor number nine, average consumer expectations for business conditions. This one's about how optimistic people are about the future in the economy. When people are feeling good about the economy, they tend to spend more. Our economy is based on spending, and that stimulates growth. And finally, factor number 10, the ISM New Orders Index. This one is based on a survey of purchasing managers in various industries. It gives us an idea of demands for goods and services. When this index is on the rise, it suggests the economy is likely to grow. So there you have it. That's the 10 factors that make up the Conference Board's Index of Leading Economic Indicators. By tracking these factors, we can help get a sense of where the economy is headed, helping businesses and investors and policymakers make better decisions. But remember, the LEI is just one tool among many used to predict the economy's future. It's not foolproof, but it can be helpful way to understand the economic trends and make informed decisions. So that's it for today's episode. I hope you have a better understanding of the Conference Board's leading economic indicators index. If you like this video, please be sure to give it a thumbs up and subscribe to our channel for more of these easy to understand explanations of complex topics. Thanks for watching, and we'll see you here next time.